The secondary market is a dark place on the web where mortgage companies trade mortgages for corgis. Rates are the lowest it's ever been, which is bringing buyers back onto the market. In fact, it's even encouraging those who haven't even been thinking about buying anytime soon to explore the possibility of buying this summer. However, many Americans will find it much more difficult to qualify for a loan later this year. Why? Lenders are tightening up and they're being more cautious. Roughly 3.5 million Americans are not making their mortgage payments right now due to COVID-19. In preparation for the possibility for a wave of foreclosures, many lenders are increasing their qualifications for credit scores and down payment in an effort to minimize loaning money to riskier borrowers. Before COVID-19 hit, a borrower could qualify for a government-backed loan with a minimum of 580 credit score, but today lenders want to see between 640 and 680. Some others like JP Morgan Chase are actually requiring a minimum of 700 credit score and 20% down just to qualify for a loan. If you're self-employed thinking about buying this summer, you may find it a bit more challenging to qualify for a mortgage. Now, normally lenders verify a borrower's income by looking at W-2s, pay stubs, tax returns, but a self-employed borrower uses bank deposits to prove income. So it's a little riskier. So in an effort to protect themselves, lenders are charging additional fees and sometimes only considering a portion of their self-employed income from the prior year. So let's say you made 100K last year and the lender's overlay allows only 70% of your income to be considered, then you'd qualify for only $70,000. If you were thinking of using a low down payment program like FHA, it may be more expensive to use. While the availability of low down programs will likely still be around for the foreseeable future, lenders know these programs are generally catered towards borrowers with lower credit scores, lower down payments. In other words, it's a higher risk for the lender. So how do they protect themselves? Well, lenders are increasing fees considerably to dissuade borrowers from using these low down payment programs like FHA. They'd rather you save up more money and improve your credit score to qualify for, let's say, a conventional loan. So banks try to minimize the amount of loans in their books because it prevents them from making more loans with more clients. So what they do is they'll sell them to investors in the secondary market. The secondary market is a dark place on the web where mortgage companies trade mortgages for corgis. Just kidding. The secondary mortgage market is a place where mortgages and servicing rights are bought and sold between lenders and investors. This is important because when a loan is sold, it frees up capital for banks to do more loans with more people. If the bank can't sell the loan in the secondary market, it's stuck in their books and their ability to do new loans will be hindered. In short, banks don't want to do jumbo loans because they're riskier right now since unemployment and mortgage forbearance are super high. Let's say you qualify for a loan. You find a home, you enter a 45-day escrow. When you're buying a home and taking out a mortgage, the lender that you work with will verify your employment and income about 7 to 10 days prior to closing the deal. Right now, that's happening much later. In our current market, lenders are actually verifying a few days prior to closing and sometimes even on the day of closing. Imagine you're about to close a deal, you've invested all your time, energy, and money into buying a home, and on the last day of escrow, your deal falls apart. But that's what's happening if your job situation does change, so be aware. These stricter lender adjustments may be temporary due to COVID-19 affecting the housing market, but it's probably for the best. We're only 12 years removed from the 2008 Great Recession, and although it's not the same situation, people still remember it. Lenders want to make sure they're loaning money to the people that are qualified and won't struggle with making their payments. Hope this helps. Message me for any questions.